non-farm payrolls, it's always important that we see what the dealers have done with the prior rotations. And then this is the key. Heavy shorts with rotations on misses, because that key allowed us to come up with this narrative here before the data. And you saw that we drew this out before today's non-farm payrolls. We had 75% probability of a winning short and 25% probability of a winning long position. One of the other things that we also noticed last night in the tweets, you might have been able to pick up on it, of course, was the VIX storyline. The VIX storyline is quite clear. We can see that we've been very, very bearish on the VIX. Now, obviously, as we come into the data, the at the monies are going to go to zero, basically, because it's not going to stay at the monies. But we can still see that the underlying skew is still very, very bullish for the VIX, which means bearish for equities. But it wasn't just that, was it? If you look at the tweet just above it at the same time, what direction would this tell you the market was going to go into today in terms of the equities? What would that tell you about market direction? It must give you a clue about market directionality, otherwise we wouldn't bother tweeting it out, would we? It tells us that the market's going to be bearish, right? It tells us that the way that the dealers are dealing this, on the face of it, seems to be that the market is going to be sell-side business. Because if the discretionaries are bearish and the staples are bullish going into a non-farm payroll, you'd imagine that everybody's bought defensives and everybody's dropped their growth stocks like a hot potato, right? So in other words, we look at that and we say, well, if the discretionary is bearish and the staples are bullish and the volatility is bullish, everything points to one of these scenarios, doesn't it? Everything points to one of these three scenarios. You agree with that? Have we come up with anything that was bullish equities at all out of any of the tweets that you've seen? Out of any of the information we've talked about, any of that stuff that would have told you otherwise against this trade? Now, as I said again, guys, I'm not saying you should be trading these. What I'm saying is you should be understanding them. That's the key part to this, isn't it? You should be understanding them so that you can see how we make money. If you want to take that play, if you have a desire to be involved in that bit of business, you can now see how to be involved in that bit of business. Really, really clear ideas building around other things happening that are not directly related in any way, shape, or form, perhaps to non-farm payrolls. But you can see that these ideas help us form opinions about possible scenarios. How the market deals allows us to form this opinion here. So this here has got nothing to do with this here. This here, the fundamentals, has everything to do with this here. And what these rotations do is they start weighting these accordingly, right? So if I look at a VIX that's bullish, and if I look at a rotation here, do you think this line here is a 50-50 chance, yes or no? Would you say that this is a 50-50? So it's 50-50 going up, 50 going down. Would you say that's correct based on this situation here? Based on the volatility going higher, based on discretionaries being bearish and staples being bullish. Do you think it's a 50-50 chance? So if it's not a 50-50, it must be something else, right? We can argue that it's maybe a 60-40, right? So let's assume we change it to a 60-40. Reasonable? So if we change it to a 60-40, and this here is 50-50, right? This here is 50-50, but we've got more downside potential here, then we could say, well, it's not quite 50-50, is it? It's more 60-40 because the upside is limited, but the downside is still definitely going to be a little bit more fluid. So we would change that to a 60-40. What is now my probabilities of getting this trade wrong? It's now 16% probable, isn't it? I now have a probability of 16% in getting this trade wrong. Yeah. So I now have an 84% probability of a successful outcome on that bit of business. Does everybody agree with the arithmetic? Now, obviously, it's whatever it is that you're working on. I mean, you don't have to say 60-40. I'm just giving you some ideas. I mean, obviously, we're not saying it is 60-40. We're saying it would be weighted in line with that 60-40 type ratio. You could argue that it was 70-30. You could argue that it was 80-20, in which case the percentage is a lot less than 16%. But obviously, we've been just edging the advantage on the sell side on both occasions. And if we edge the advantage on the sell side on both occasions, then it turns it from a 60-40% to an 84-16%. You see the difference? So I've got a very, very high probability short sell coming in. So I really did like the short. I talked about the short actually this morning in the classroom when we talked about the NASDAQ short that came in. And, you know, we obviously put across a couple of quick charts to show what it was we were considering on this. And it was a way back yonder when we were talking about this short sell here. Remember, we talked about that one, and we also talked about that big short at the top edge up here. And we'd managed to get some nice rotations out of these little keys. Yeah. But I think Kim's already, I noticed it's been recorded anyway, so we can have that posted. But there you go, guys. It's just how you do fundamentals. If you don't like it, if it's too wishy-washy for you, if it's too variable, if it's too not quite certain enough, okay, that's fair enough. But at least try and do it. At least try and work on it. Think about it like this and try and work out what you've seen before, what the probabilities are, how you can think about it in terms of this fast money, slow money. Because if you look at that and I said to you, okay, based on my drawing, you can all agree that the drawing is based on the fundamentals, right? So we know that in advance. Where is the fast money? And where is the slow money? Just look at my drawing. The fast money's here, and the fast money's here. Agreed? So all the only two fast money candles are both bearish. So the fast money narrative is bearish. The slow money narratives are all these bullish responses, aren't they? So even if we're wrong, we're not going to lose a lot of money because we're going to have time to make a move. We're going to have time to get away from a trade with a small loss versus a potential upside profit, a substantial upside profit. So an 84% probability of a profit, but also we're probably now looking at this and saying, well, you know, based on a risk rewards, I would imagine that for every 10 ticks I'm going to risk on this, I'm going to make maybe about, say, 30 ticks. So for every 10 tick risk, I'm going to make 30 ticks potentially, just as a rough guide to that type of idea. So when we look at that percentage, when we look at that idea, we say, well, it's 75 against 25. Do you look at the positive expectancy on that trade? It's enormous, isn't it? If I can win 84% of my trades and I make 30 ticks, and on the other 16% of the trades I lose 10 ticks, would I have a massive positive expectancy? I would have a massive positive expectancy, right? So when you think about that, you start looking at it from that point of view. You say, well, you know, what is there not to like about this deal? And that's when you become a fundamental trader, when you start going through that type of process. But it takes a bit of time and a bit of work to go through the narrative. As I mentioned, if the top edge S&P was in place, I would have been a 100%, let's just get this short because I don't think you're going to lose any money type trade, you know, because regardless of what happens, I think we're probably going to see a lot of profit takers on any spike higher, you know. But anyway, non-farm, I'm done and dusted again, so that's going to cause a bit of a hole in everybody's calculations, isn't it? That's not a good thing at all.